Welcome to the deep dive. Today, we're jumping into fair value measurement under U.S. GAAP.
Yep. Try to cut through some of that complexity.
Exactly. We want to get to the core of what fair value really is, why it matters for understanding financial statements.
That's fundamental, really, not just some abstract rule.
And just to be clear up front, we're talking about the main definition here, things like share-based payments or lease accounting. They have their own specific guidance.
Right. Separate playbooks for those. We're focused on ASC 820, the main framework.
Okay, so let's dive in. At its heart, what is fair value?
Well, simply put, it's the price you'd receive to sell an asset or pay to transfer a liability.
Okay, the price.
But crucially, it's in an orderly transaction.
Yeah.
That means, it's not a fire sale or a forced liquidation. The asset has reasonable exposure to the market.
Gotcha. Not a rush deal. And who's involved in this hypothetical transaction?
That's the key part, market participants. These are buyers and sellers who are independent, knowledgeable about the asset, able to transact, and willing to do so. They're acting in their economic best interest.
So it's based on what they would pay or demand, not what the company holding the asset thinks it's worth internally.
Exactly. It's market-based, not entity-specific. We're looking outwards.
Okay. And where does this transaction happen? Is there a specific market?
Good question. We look first for the principal market. That's generally the one with the highest volume and level of activity for that asset or liability.
And there isn't one clear principal market.
Then we figure out the most advantageous market. That's the one that maximizes the amount received to the asset or minimizes the amount paid for the liability after taking transaction costs into account.
Okay. So transaction costs help determine which market, but they aren't actually deducted from the final fair value figure itself.
Correct. The fair value is the price in that principal or most advantageous market before those selling costs, unless maybe location is a factor in the asset's value itself.
Can you give us a quick example? That market part sounds a bit tricky.
Sure. Let's say Gertie Inc. holds Foxycone stock. It trades for $52 on the New York Exchange, but costs $2 to sell there. It also trades for $50 in London, costing $1 to sell.
Okay.
If New York is the principal market, the main one fair value is just $52. Simple.
Before costs. Got it.
If London is the principal market, fair value is $50. Again, before costs.
Right.
Now, if neither is clearly the principal market, we see which is most advantageous. New York nets, $50, $52. London nets, $49, $51. New York gives a better net amount.
So New York is most advantageous.
Yes, but remember, fair value is the price in that market before our costs. So fair value would be measured using the $50 price from the London market because that market yields the higher net price after transaction costs. 49 versus $50 net from NY example before correction. Sorry, I misspoke there. The New York market yields $50 net, London yields $49 net. So New York is the most advantageous market. The fair value is the price in that market, $52 before the transaction costs.
Ah, okay. $52 it is, then, in that last case. It's subtle. It's really an exit price, what you get when you leave, not the entrance price you paid.
Precisely. And it reflects assumptions market participants would make, including about risk.
Now, what about physical things like land or a factory? Does the market participant idea still apply?
It does, but with a twist. For non-financial assets, we consider their highest and best use.
Highest and best use, meaning?
Meaning how the asset could generate the maximum economic benefit for market participants. That might be using it as it is, or maybe using it differently, or even selling it to someone who would use it differently.
Like maybe a factory site is actually worth more if sold for residential development.
Exactly. We'd consider the value in that alternative use, perhaps less the costs to convert it. We usually assume the current use is the highest and best use, unless market factors suggest otherwise.
And that doesn't apply to financial assets, right? Like stocks or bonds.
Correct. Financial assets or liabilities don't really have alternative uses in the same way a physical asset does. Their value isn't typically tied to being used with a group of other assets.
Okay. And briefly, what about valuing liabilities like debt?
For liabilities, a key factor is non-performance risk, the risk that the obligation won't be fulfilled. That needs to be reflected in the fair value.
And if a company has its own stock classified as a liability,
you'd look at it from the perspective of the market participant holding it. And the assumption is generally that the liability or equity instrument is transferred. It remains outstanding, not settled immediately.
Right. So, okay, we understand the what and why. How do companies actually calculate this fair value number? What are the methods?
Right. There are three broad approaches. First, The market approach, looking at prices and info from market transactions involving identical or comparable assets or liabilities.
Makes sense, like seeing what similar houses sold for.
Exactly. Second is the income approach. This converts future amounts, like cash flows or earnings, into a single current discounted amount. Think discounted cash flow analysis.
Okay.
And third, the cost approach. This reflects the amount that would currently be required to replace the service capacity of an asset, often called current replacement cost.
And can you mix and match these?
Oh, absolutely. Often, using multiple techniques and then weighing the results is the best way, especially for more complex assets.
Now, I've heard about a hierarchy. Level 1, 2, 3 inputs. What's that about?
Ah, yes, the input hierarchy. This is critical. It prioritizes the inputs used in those valuation techniques. Level 1 is the top priority.
And level 1 is?
Quoted prices in active markets for identical assets or liabilities that the company can access. Think of stock price on the NYSE. It's the most reliable evidence of fair value.
Okay, observable, identical, active market. What's level 2?
Level 2 inputs are still observable, but they're not quite level 1. This could be quoted prices for similar assets in active markets, or prices for identical assets in markets that aren't active, or it could be other observable data like interest rates or yield curves.
So, still based on market data, but maybe indirectly or for similar items.
Right. Then you have level 3.
The least preferred.
Generally, yes, because level 3 inputs are unobservable. They reflect the reporting entity's own assumptions about what market participants would assume. You only use these when observable inputs aren't available, or getting them is just too costly.
So if a company's using a lot of level 3 inputs, you need to pay more attention to their assumptions, right?
Definitely. And that's why the disclosures are so important. Companies have to provide information about their fair value measurements.
What kind of information?
The goal is transparency. They need to disclose quantitative information about significant, unobservable inputs used in level 3 measurements, often a sensitivity analysis showing how changes in those assumptions would impact the value.
So you can see the potential range or uncertainty?
Precisely. They also need to disclose the valuation techniques used and the level in the hierarchy for all fair value measurements on the balance sheet. Even for some items disclosed but not measured at fair value, the hierarchy applies.
Let's take an example. Say Marker 8 company buys some stock in Millage Inc., traded actively. That's level 1, right?
Correct.
If the stock price goes up by the end of the quarter, Marker 8 just updates the value on its books.
It's essentially yes. For equity securities like that, they'd record an adjusting entry to mark the investment to its current fair value, and the gain or loss would typically hit their net income.
Straightforward for level 1. Are there times when fair value just isn't used?
Yes, there are limited exceptions. Sometimes measuring fair value might not be practicable, or it can't be reasonably determined, or maybe it just can't be measured with sufficient reliability. But these are specific exceptions.
Okay, so wrapping this up. Fair value is market-based. It's an exit price concept driven by orderly transactions between knowledgeable participants.
And the hierarchy guides us always prioritize observable market data, levels 1 and 2, before relying on internal assumptions in level 3.
Understanding this really gives you crucial insight into how assets and liabilities are valued on the balance sheet.
Absolutely. It aims to reflect current economic conditions.
So here's a final thought to chew on. We talked about market participant assumptions. How might widespread economic fear or maybe irrational exuberance change those assumptions and thus the fair value of an asset? Even if the asset itself hasn't fundamentally changed, it really highlights how value can be shaped by perception.
That's a great point. Value isn't always static or purely intrinsic. The market context matters immensely.
Definitely something to think about. Thanks for breaking down fair value with us today.